A very good morning, afternoon, or evening, as the case may be, depending on the country you're based in, and welcome to this webinar on sanctions organized by Fintelekt and Asian Bankers Association. My name is Shirish Pathak. I work at Fintelekt, and I will be your host today for this webinar. At the outset, let me thank the Asian Bankers Association for partnering again with us for this webinar. As many of you know by now, in light of the global situation, we have increased our webinar schedule from once a quarter to once a month, and I hope this will add value to ABA members across Asia. I believe the banking industry has found this useful as well, and the fact that we have over 700 participants in this webinar today is a testimony to that. Today we have 4 guest speakers: Hala Alwan from HBA Consultancy, Vincent Gaudel from Accuity, Nicholas Turner from Steptoe and Johnson, and Surendra Thapa from the Global Intelligence Analysis Corporation. All of our speakers are available on LinkedIn, and I would urge you to connect with them after the call should you wish to get any more advice from them. There are a number of key issues related to sanctions that we will discuss on the webinar today, namely the evolution in sanctions over the last few years, recent trends in the sanctions environment, what is the implication of sanctions on how banks conduct or should conduct business, how can banks keep track of frequent changes on global sanctions lists, and key considerations for banks' sanctions compliance programs. We will attempt to take questions from the audience at the end of the webinar. However, online platforms, including this one, are facing a severe stress of overload at this point in time. And just in case it doesn't work out logistically, please email your questions to us at contact@fintelekt.com, and we will try our best to get our guest speakers to answer questions offline for you via email. Hala, Vincent, Nick, and Suren, thank you for joining us today. Let me begin by posing my first question to Hala. Hala, OFAC sanctions have been increasingly complex and rigorous over the last few years. Penalties have increased manifold, and tolerance to violations seems to be going down. The impression many banks in Asia and in other parts of the world have is that sanctions risks apply only to large multinational banks that have significant US dollar transactions. Can you comment on this, and what would your advice be to banks?
Thank you, Shirish, for the introduction, and thank you to the great audience. Hope everyone is safe and healthy. Also, thank you for leading knowledge awareness campaigns, podcasts, and webinars, Shirish. It adds huge value to the community. Thank you for that. Going back to your question, I would like to define the role of OFAC before answering the question. The Office of Foreign Assets Control, the OFAC, of the United States Department of Treasury administers and enforces economic and trade sanctions based on U.S. foreign policy and national security goals against targeted foreign countries and regimes. Terrorists, international narcotics traffickers, those engaged in activities related to the proliferation of weapons of mass destructions, and other threats to the national security, foreign policy or economy of the United States. So many of these sanctions are based on United Nations also, and other international mandates are multilateral in scope and involve close cooperation with allied governments. So if we read what's the role of OFAC, we can see that nothing mentioned restricts its impact on large banks only. That's a start. And this is a huge misconception, as usually it's linked to large amounts of illicit funds. So people think large amounts, this means large banks. That's surely wrong. On the contrary, criminals use small banks to hide their illicit funds or layer it through the financial system. They take advantage of the fact that the small banks want cash and more business, especially the newly established ones or small branches. So they'd sometimes turn the blind eye on a strict KYC or certain transfers which offers traditional timely liquidation. Or they may structure, for example, the criminals may use small banks to structure cash deposits to avoid threshold reporting requirements. I'm not talking about all small banks, but definitely there are small banks which they sometimes apply not the required, let me put it like in a diplomatic way, not the required know your customer or onboarding process. So as we said, like Criminals also may structure cash deposits to avoid threshold reporting requirement. As we said, deposits to avoid threshold reporting requirements may not be as strict and persistently assess this particular bank's compliance program like they do with larger banks. Because sometimes also, unfortunately, in many countries, regulators focus more on larger banks, while they should focus as equally as they should focus actually in an equal manner also on the smaller banks, for the reasons we've mentioned and many other reasons. We just gave examples here. Saying all of that, for small banks and other financial services firms, it's not only for banks, also financial services firms, all this means that regardless of your size, you are vulnerable, and in my opinion, more than the large banks. Thank you, Shirish, and over to you.
Hala, thank you for that. Let me now move this question to Nicholas Turner of Steptoe and Johnson. Nick, could we get your comments on this question?
Sure. Well, it's certainly true that banks that have significant exposure to the U.S. financial system do have elevated OFAC risk. And that's because transactions that pass through the U.S. financial system are subject to OFAC enforcement jurisdiction. And that means that banks that use the U.S. financial system have to ensure that their transactions comply with all of the relevant regulations. So for example, let's say that a bank in Asia is performing some trade finance related to Iran. That might be perfectly legal in the jurisdiction where the bank is based. However, if that trade finance will involve banks that are in the US financial system, those may be prohibited transactions. And what happens is that if a counterparty bank has to reject a transaction, whether it's a letter of credit or a funds transfer or some other type of transaction, that gets reported to OFAC. And those reports can become the basis for future OFAC investigations or even enforcement actions against the banks that have taken part in the transaction. So it's very important for banks anywhere in the world really to pay attention to this issue. But putting aside this question of the US financial system, even banks that mainly have their business in the region also have to think about OFAC sanctions. And there's a couple of reasons for that. The first is there increasingly is an expectation for correspondent banks and other counterparties that there's going to be a certain level of OFAC compliance. And so even if you don't find yourself subject to OFAC jurisdiction from a legal point of view, you might still have certain expectations from your counterparties that you're going to do some compliance. And the second thing, and this is probably the one that people think of most often, is secondary sanctions risk. There are a number of authorizations under US law that allow the US State Department and OFAC to apply sanctions against foreign financial institutions that engage in certain activities. And this could include activities involving North Korea or Iran, or in some cases, activities related to terrorism or proliferation. All of those could lead to the use of secondary sanctions, which mainly are designed to cut off access to US correspondent accounts. And this could be an OFAC designation, like an SDN designation, or it could even be a Section 311 designation, which is a list that is sometimes called the 311 list or the 311 list, which effectively cuts foreign financial institutions off from US correspondent accounts. That's a significant impact. It has a reputational impact, a commercial impact, and obviously a legal impact. And so banks anywhere in the world need to be thinking about these issues.
Thank you, Nick. Let me move this question for the last time to Vincent Gaudel. Vincent, if I may have your comments on this question.
Yes, sure. So I think there is little debate on the fact that the US have been using sanctions aggressively over the past few years. It's not entirely new. As you can see on this chart, the number of entities sanctioned by OFAC has been consistently higher than those sanctioned by the UN or the EU, for example. But the current US administration has extended the gap even further, and the OFAC list grew since 2016, primarily as a result of maximum pressure applied to Iran and Venezuela. The US list grew 40% since 2016. Also, these figures don't tell the whole story about sanctions complexity, and the actual number of designated entities is actually much higher. Some sanctioned entities are not mentioned in the OFAC list, and there are two main reasons for that. First, the 50% rule, under which entities owned directly or indirectly by one or more sanctioned entities are also sanctioned. US sanctions were recently imposed on broad categories of entities, such as the government of Venezuela, as well as Russian sovereign entities. On top of that, it's also true that sanctions measures may be diverse and limited in scope. Sectoral sanctions are a prime example for that, as they restrict only some activities. There are also exceptions, licenses that may apply, and so actual case-by-case analysis of any transaction may be in order. Now, if we consider OFAC enforcement actions, whether it's hard to demonstrate that fines have been increasing constantly, there are still two pretty evident takeaways. So the first takeaway is that no industry is immune from OFAC scrutiny. And you can see it on this chart. This is a representation of a breakdown of OFAC enforcement actions by industry since 2014. The important figure here is that 2/3 of the actions were taken against regular corporations, not banks. Banks have paid the highest dollar amount, but they are larger entities, and smaller fines don't mean companies haven't been hurt. The second takeaway is that OFAC is aggressively enforcing sanctions violation, and OFAC settlement constitute a strong incentive for global institutions to comply with US sanctions. OFAC is setting expectations when publishing those settlements, and reading carefully through these decisions is critical to understand OFAC expectations and assess a compliance framework adequacy. So therefore, it's critical for every company to assess to what extent they are required to comply with OFAC sanctions, not only because they are owned or operate direct business in the US or process transactions in US dollars, because OFAC is also claiming jurisdictions on transactions involving US origin goods or technology. And finally, some sanctions regime also include secondary sanctions, which means non-US persons are also required to comply. This is a representation of what are called secondary sanctions.
Thanks, Vincent. So sanctions regimes have been very dynamic. Just in the last year, the Iran, Russia, and Venezuela regimes underwent significant changes. Sanctions were imposed on Turkey and then revoked. Could you give us an overview of these challenges? And maybe, Hala, if I may start with you again.
Thank you, Shirish. I totally agree with you. It's changing all the time, confusing sometimes, and contradicting in other times as well. I was reading a report by Control Risk on this topic, and they summarized these trends brilliantly. I urge everyone to read it. It's worth reading. So going back to your question, Shirish, in summary, the reason of these changes are as follows. So the US is introducing and enforcing sanctions more frequently. And in many cases, there's disagreement, even within the US, on the use of sanctions. So for example, policymaking under Trump often shows differences between the president's intentions and members of his administration and the Republican Party. In addition to this, the EU and the US are growing apart on sanctions policy. Nevertheless, the divergence between Trump's US and key European allies on major foreign policy issues. Also, the US is encouraging its allies to adopt their own sanctions. For example, by the way, Gulf states have joined this trend. developing blacklists of their own. International financial hubs like Switzerland, Hong Kong, and Singapore have also traditionally maintained independent sanctions regimes to counter terrorist financing, money laundering, and other transnational threats, though these are most aligned with the United Nations. Also, extraterritorial regimes that apply to persons in countries not otherwise subject to sanctions are likely to continue to spread. Moreover, many sanctions have also been subject to ongoing additions, the same sanctions, or deletions, or amendment, adding significantly to the compliance burden. Absolutely. So the last few years have not only been characterized by increases in sanctions-related activity, but also by divergent sanctions regimes across the globe. So a clear rise in national sanctions has seen the US as the most prolific implementer, but of course not the only actor. The EU remains the major sanctions legislator. So saying all this and summarizing the changes or the confusions, what does this create for banks and also organizations in general? The sanctions landscape is more complicated, challenging, and inconsistent than ever before, and alongside this scenario, regulatory scrutiny continues to rise, as we all know. So just a quick overview published by Refinitiv, former Thomson Reuters, my previous employer. See this difference, which is very interesting. In September 2017, there were 21,091 total explicit sanctions across 231 sanctions programs, issued by 38 countries or international regional bodies. By February 2020, 2 months ago, this number had grown to 34,155. A 62% increase across 281 sanctions programs issued by 50 countries or international regional bodies. So we see the number, 21,091 in 2017 jumped into 34,155 in 2020. Much of this increase was down to a sharp rise in the number of sanctions from the OFAC, US Treasury, over the period, of course. So at an organizational level, this implies that compliance professionals face significant sanctions-related challenges which needs to be tackled on the spot. Thank you, Shirish, and over to you.
Thanks, Hala. Vincent, if I may ask you, how can banks effectively deal with the large number of changes?
As sanctions are tools of foreign policy, they are an ongoing reaction to international issues. Here is a chart displaying, for 2019, updates published by 4 major regulators. As you can see, there is not a single month without an update, meaning that complying with sanctions is an ongoing challenge. Those changes can be explained by a variety of reasons. First, the long-standing sanctions regime evolved over time as a result of the changing nature of the threats. A good example for that is the increasing number of vessels being sanctioned by the US in relation to North Korea, Iran, or Syria, for example. There is a strong scrutiny at the moment over illicit trading activities such as ship-to-ship transfers. Second, as you rightfully noted, 2019 saw significant new measures added to existing sanctions regime as a result of the continuing threat. Blocking sanctions were imposed against the government of Venezuela. Financial restrictions were imposed on Russian sovereign entities, and additional Iranian economic sectors were restricted as well. At the same time, sanctions can swiftly be imposed when new threats to international peace emerge. Sanctions imposed by the US on Turkish officials are a prime example to this. The US swiftly blocked 5 entities when Turkey conducted a military operation in northern Syria. Sanctions were in effect for just 9 days until the Turkish army terminated its operation. Finally, I want to mention sanctions imposed in relation to human rights violation and corruption. 2019 saw a doubling of entities sanctioned under the Global Magnitsky Act. This act is precisely designed to reprimand severe human rights violations and corruption. It was through this act that the US sanctioned the alleged perpetrators of Jamal Khashoggi's murder. Jamal Khashoggi was a Saudi reporter killed at the Saudi embassy in Turkey back in 2018. So the practical implications for corporations of these constant changes is that an ongoing regulatory watch needs to be in place. It is critical that sanctions are implemented without delay, so that sanctions targets cannot hide their assets. Taking new sanctions measures into account can be a complicated process because it requires not only to acquire the new sanctions lists, but also several operational steps to ensure it will properly be processed by the screening engine. Therefore, I think it's important to stress out the importance of both robust sanctions list management process, as well as reliable sanctions expertise for firms to clearly understand their sanctions risk exposure and design the adequate mitigating measures.
Thanks, Vincent. Vincent, what are the challenges with the way banks are screening for SDN matches, and how can technology help banks improve the efficiency in doing this? And apart from using best-in-class technology solutions, what are the elements that banks must include in their sanctions programs?
So technology is definitely an important factor, but it's hardly a standalone component. Actually, at a high level, I typically represent three key components to a good sanctions program: data, technology, and human expertise. So first, let's start with data. It sounds obvious, but if you do not have good quality information internally about your counterparties, the best technology won't be of much help. But it might be more complicated to achieve than it sounds. Not only can internal data can be lacking, inaccurate, or outdated, there are also operational hurdles related to the way customer information is structured, or difficulties related to the fact that this data can be spread across several systems or databases, which result in heterogeneous data. I would suggest that the primary quality objective for firms when looking at their sanctions compliance program is to first look at what customer data they have, what they are lacking, and how well this data can be used in automated screening software. Then, watchlist data is just as important. It's critical for compliance that your sanctions program includes all relevant sanctions lists. You should first ascertain, and that might require taking specialized legal advice, that you have identified all relevant sanctions lists for your operations. Then, the primary quality aspects for sanctions lists are not only their completeness and accuracy, that goes without saying, but it's also related to timeliness for accounting for the updates. And on top of that, as we have seen, in some instances, compliance requires to go beyond the official lists. So take into account the OFAC 50% rule, for example. Second key component is technology. Sanctions compliance technology is often implemented to make screening processes more efficient, but for larger firms, it has become instrumental for the very effective compliance with sanctions regulation. Sanctions technology must be adequate to each firm's risk exposure, and there is no one-size-fits-all technology solution. Firms with a small and stable customer base may not require the most sophisticated data analytics technique or screening engines able to process millions of records in seconds. But there are, however, minimal capabilities that are mandatory for compliance. First, sanction screening requires fuzzy matching technology. Names may be spelled in a variety of manners, so you need your software to detect similarities, not only exact correspondence. Second, you should look for linguistic capabilities for matching a certain set of characters against another. Finally, a screening tool should be configurable, enabling you to set rules and to adjust the matching sensitivity according to your risk exposure. So screening technology should be tested with the company's data before it is implemented and regularly tested once implemented to make sure all relevant alerts are correctly generated. And third key component is expertise. It is the final factor, but the human factor must not be omitted. You will need to have competent resources internally for designing, implementing, and maintaining your sanctions program. Even the best screening tools would not protect your organization if your staff is not properly trained and skilled on sanctions compliance.
Thanks, Vincent. So my next question is, to mitigate these diverse, ever-changing sanctions challenges and stay ahead of the game, what are the elements that banks must include in their sanctions programs? And is there any similarity with this and AML KYC processes? Let me pull in Surendra Thapa here now. Surendra, if I may have your comments on this.
Okay, so I guess I'll begin by identifying the common elements and then also go into the distinction between sanctions compliance and AML KYC compliance. So I believe most of the large institutions now have a consolidated sort of like the anti-financial crimes programs, so in which sanctions and anti-money laundering both are part of that larger compliance program. And the way to look at it is basically a lot of sanctions evasion tactics, for example, utilize money laundering, classic money laundering tactics, which is basically to disguise the source of funds, hide the originator or the beneficiary or the purpose underlying the transaction. So one of the so in that sense, these sanctions compliance and anti-money laundering compliance goes hand in hand. One of the root causes of violations that OFAC has identified is certainly it begins at the onboarding phase, whereby you clearly identify who the client is, their risk profile, and in addition to that, the jurisdictions in which the entity or individual resides, and so on and so forth. In addition to that, a robust KYC program will also basically at the time of onboarding, screening has to be done to ensure that the potential client is not on any of the sanctions list. In addition to that, the screening also accomplishes whether or not a good onboarding due diligence program will have to check the PEP, politically exposed person status of your potential client, and PEPs, because of their status as politically connected or exposed persons, with respect to sanctioned country programs and what have you, they are high-risk individuals. So, so in that sense, there is a lot of similarities between between AML and KYC. And in terms of, although in sanctions, you might think that all it entails is screening for the individuals and checking it against a sanctions list, that only starts the process. You still have to go through the money laundering sort of like an analysis. Whereas that is sort of the similarity. The difference in the two is basically money laundering investigations and analysis of flagged transaction. The predominant concern there is to determine whether or not a transaction is suspicious. And a suspicious transaction may entail an effort to evade sanctions. Whereas a sanctions analysis, after you flag a certain transaction, there's a deeper level analysis involved, which entails actually looking at whether or not a particular flag transaction, whether or not the individual is on a sanctions list or not, or whether or not the underlying nature of the transaction falls into a sanctions program, a broader sanctions program. So in essence, what I'm saying is, although there are a lot of similarities in which processes can be leveraged, but full consolidations of the two programs is not advisable because the N-level analysis is a little bit different. So basically, my recommendation is, for example, the Office of Foreign Asset Control, OFAC, has recommended all the banks should have an effective sanctions compliance program in place, an agile and responsive sanctions program. And according to their recommendation, the program needs to be capable of adjusting rapidly to changes published by OFAC, which are basically updates to the OFAC list, new amended or updated sanctions programs, and things like issuance of general licenses. And basically, when OFAC has conducted enforcement actions and has publicized what are the root causes for banks facing enforcement actions, they have pointed to the fact that the banks did not have a sanctions compliance program. So basically, you need a sanctions compliance program. That is the only way to do it, and up-to-date sanctions compliance programs. And briefly, I will just go into, I'll just list some of the components that an effective sanctions compliance program should have. The first of which is management commitment. Basically, the top level management has to ensure that the organization is compliant. There's a culture of compliance. They also have to ensure that everybody follows the rules and that there is enough resources committed to making the organization compliant to sanctions programs. The other element is risk assessment, basically to allocate the resources more effectively. And the program needs to have effective internal controls, written policies and procedures, which basically lays out clearly what are the expectations of the employees so that the organization is compliant and basically has to enforce those policies and procedures. The program needs to be tested and audited for effectiveness, to identify problems, to identify gaps, and how to remediate such problems identified. And finally, the last of which is, of course, training. All the employees need to be trained periodically because, as you said, the space is very dynamic these days, so the trainings have to be frequent. And so just as a brief aside, one of the enforcement actions that recently happened with Swedbank, this was a huge issue. In particular, the report pointed to basically whether or not the management was very serious about the programs, the compliance program. And the compliance program, of course, has to be enterprise-wide and not just the head office. So you should incorporate subsidiaries, affiliates, clients, and all such people into that program. So briefly that, I guess.
Thanks, Surendra. Hala, could you share your thoughts on this as well with us?
Thank you, Shirish. As we mentioned, all the challenges explained in the previous discussion add pressure and heavy burden to banks. Hence, having a proactive sanctions program is a key here. And to have this efficient program, banks should surely have sanctions screening tool before anything else. As everyone should know, performing sanctions search manually can be definitely challenging and inefficient. So human error may also lead to inaccuracies and the risk of penalty fines, etc., etc. Using an automated sanction screening tool is very important to minimize that risk. However, is that the only thing? Definitely no. After screening, banks should conduct EDD and enhanced due diligence on any individual or entity flagged as suspicious. So the screening tool database should cover all known sanctions lists, any lists which the country you're operating in, whether where you reside, you do transactions, is exposed to, which should be monitored and covered definitely on a 24/7 basis, ensuring completeness, accuracy, and validity of all the sanctions update. Otherwise, the tool will be inefficient. This is alone not enough. Banks should develop a best practice response. And one of the good things I urge everyone to read is the United Nations address some of the complexities and challenges faced by organization in this manner. And it's very nice to read with examples. So please, whomever is listening to this webinar, please go and read those best practice response guidance from the United Nations. It's very clear and it's really helpful. So I'm going to summarize them here. Most important for when the United Nations address that is highlighting the red flags that can be of high risk. For example, common behaviors and characteristics. For example, when there are transactions that involve companies or recipients operating in countries under sanctions or to neighboring countries. Aberrations in trade practices. For example, where offers in terms of payments are inconsistent with observed industry norms. Ambiguous identity or documents and behaviors. For example, where the authenticity of identification and travel documents cannot be verified. Finally, suspicious financial transactions. For example, where a financial transaction does not fully disclose a transaction parties. And actually, if you can see here, this is not new. This shouldn't come as a surprise for sanctions officers, compliance officers, because this is exactly when we do anti-money laundering, counter-terrorist financing, those are things we look at as red flags. And to be able to do all this with whatever we explain now in this discussion, you have to understand how sanctions violation occur. Like self-knowledge and education is very important in this element, because you should understand, for example, how OFAC interprets companies' practices and behaviors towards compliance, and the types of remedial steps that organizations are encouraged to adopt to improve their compliance processes. If you understand the thinking process, why this happened, you will understand the transaction, your customer transaction, and link it in a way. It's very important to understand how sanctions violations occur and how any sanctions agencies of US Treasury, EU, United Nations, etc. interpret companies' practices and behaviors towards compliance. It's very important. Also, the due diligence, which you do, it shouldn't come as your immediate counterparties, KYC. Similar process, actually, also, it's not as a surprise, similar process to what we do in AML, anti-money laundering. For example, sanctions exposure throughout your value chain, supply chain, suppliers, throughout the customers, third parties, vendors, and everything in between, of course. And finally, again, this is very important, is having a special skills team. So in addition to the training, which we highlighted before, having a special skills team is important. Why we're saying that? Because there's a common, sometimes misunderstanding that any legal officer or any financial crimes officer or any compliance officer can be sanctions officer. Well, the answer is wrong, is no, not everyone can do this role. Because in addition to the regulatory background, diplomacy and politics knowledge can add lots of value here. So a combination of both is a key here. Thank you so much, Shirish, and over to you.
Thanks, Hala. So Standard Chartered Bank was recently levied a huge sanctions penalty in the UK. What, in your opinion, are the differences between the US and the UK or any of the other major sanctions regimes? And how should banks put in place a comprehensive program to deal with all of these sanctions regimes? Nick, if you could take that.
Sure. The question of UK sanctions is really interesting these days because with Brexit, there's been a lot of attention and a lot of discussion about what UK sanctions are going to look like in the future. And I think what we're seeing, especially with the Standard Chartered case, is that the Office of Financial Sanctions Implementation in the UK is going to be a very serious regulator. It looks guidance that they've given that they have high expectations for banks and other companies for how they're going to comply with UK sanctions. And they're certainly not afraid to use their enforcement power in order to send a message to the market. Now, the Standard Chartered case was particularly interesting because it was brought under some EU sanctions, and those particular EU sanctions included an exception in them that allowed financial institutions to process transactions related to EU trade. But in this case, which involved a Turkish bank, which was subject to sectoral sanctions, there were a number of transactions that fell outside of that exception. And so you had the UK regulator looking very closely at Standard Chartered's transactions in order to distinguish between those which were allowed under the regulation and those which were not allowed under the regulation. And that's a very detailed analysis because it requires looking into a lot of historical data and really considering each transaction very closely. And that signals to me that the regulator, they're going to expect financial institutions to have a similar thinking about compliance, one that is very detailed, where financial institutions in particular are going to be expected to understand the rules very well and to implement compliance systems that are detailed enough to comply with these very intricate regulations. So I think that's going to be a fascinating area of development. And I think what we're also going to be seeing outside of the UK, especially in the European Union, in Australia and in other jurisdictions, are regulators looking at sanctions as an area for increased enforcement. And like we've seen in the UK, I think they're going to be giving a lot more guidance on what companies should be doing in terms of compliance. And I think their standards are going to be pretty high. I think a lot of them are looking to OFAC for some inspiration, and they see how effective US sanctions have been. And I think they're going to want to see companies in their own jurisdictions start to take this issue very seriously.
Thanks, Nick. Vincent, could I get your comments on how banks could put in a comprehensive program to protect themselves from sanctions risk?
So I will not comment on that specific case, but still it's worth noting that this bank was also fined for a staggering amount in the US last year for sanction compliance issues. One interesting point that I want to make, though, is about the strengthening sanctions enforcement in the UK. OFAC, the organization within HMT that has competence for implementing UK sanctions, was given a mandate to issue monetary penalties since 2017. The first fines were imposed last year for very modest amounts at first, and that latest penalty is the highest to date. This is an interesting indication that the UK is building its OFAC type body. As I said earlier, aggressive enforcement processes are a strong incentive for firms to comply with sanctions. That brings up the topic of sanctions risk assessment, which should be the foundation of a comprehensive compliance program. It is through that step that the relevant sanctions regulations will be identified. You will need to carefully review the geographies where you operate, including where your counterparties are located, your customer base and its characteristics, whether it's a large, changing, composed of international customers or of high-risk customers such as politically exposed persons or complex legal arrangements, and the services that you provide, notably for identifying products, services, or activities that are restricted as part of export controls or other sanctions measures. Sanctions compliance is a complex matter and requires organizations to constantly be on the watch as sanctions targets evolve over time. Ultimately, it takes a company-wide commitment. Senior management should lead that effort and communicate throughout the organization for fostering a compliance culture.
All right, thanks, Vincent. So secondary sanctions continue to be levied against companies dealing with Iranian oil. Do you think that a global sanctions ceasefire is required on the humanitarian grounds to allow sanctioned nations to tackle the pandemic? And Nick, maybe if you could take that first.
Sure. What we've seen from the US government in response to the pandemic is interesting because you've seen a very clear division between the rhetoric, which is coming from the US State Department, and the rhetoric which is coming from the US Treasury Department. So while they're both part of the US federal government, they do operate separately. They work very closely together on sanctions, but they are separate organizations. With the State Department, I think in particular with regard to Iran, but also Venezuela, there's been some very aggressive, very serious statements that have been made. With respect to Iran in particular, the State Department has accused the Iranian government of using the pandemic as an opportunity to try to gain access to cash and funds, which could be used for things other than pandemic relief. However, if we compare that with the Treasury Department, we see that the Treasury Department has been more focused on ensuring that the market understands that there are a number of humanitarian exceptions and general licenses in OFAC regulations, and that OFAC has the ability and is willing to issue specific licenses to allow humanitarian trade to occur. And the Treasury Department has been very clear, and OFAC's director has been very clear, that they will prioritize requests for pandemic-related specific licenses, and that they encourage companies to take advantage of the existing exemptions and general licenses in order to make sure that humanitarian goods get to the people who need them. So I think it's interesting to see that division between these two very important parts of the US federal government. I think in practical terms, what we're seeing is that many companies are certainly committed to contributing to pandemic relief in any way that they can. However, a lot of supplies of medical goods are currently being used domestically. This is particularly true in the United States, where there is currently a rule that is prohibiting the export of certain PPE or protective equipment from the United States temporarily. And I think that's true in a lot of countries. And so from what I understand, there hasn't been a lot of humanitarian trade directed at sanctioned territories. But to the extent that that is occurring, there's certainly a lot of legal authorizations that allow that to occur. And as I said, OFAC is encouraging companies to take advantage of those legal authorizations, notwithstanding the rhetoric that we're hearing out of the State Department.
Thanks, Nick. Surendra, could we also get your thoughts on this?
That would be desirable, as you must have seen the coverage internationally on that issue. But as a practical matter, I do not see that happening because as my guess would be, or one can predict that OFAC's response will be that all the sanctions programs already have the humanitarian relief exceptions built into the sanctions order. And as you know, recently OFAC publicized COVID-19 related guidance, which was followed by frequently asked questions in terms of what sort of humanitarian relief activities can be conducted with respect to the most severe sanctions program, for example, for Iran, Venezuela, and Syria. There are general licenses. With the case of Iran, there is General License 8, and there is a General License E, for example, which basically covers humanitarian relief, medical supplies, and things of that sort. And because Iranian sanctions is so comprehensive and complex, one has to refer to the actual document to see how the licenses actually work. And I also wanted to talk a little bit about this new program that OFAC has started, which went operational earlier this year, which is the Swiss Humanitarian Trade Agreement. And this is a joint effort with the Swiss government to allow the Swiss government to basically conduct humanitarian-related trade and transactions with Iran. And it is my understanding also that South Korea is seeking a similar sort of trade arrangement with OFAC. So due to these reasons, the exceptions built into the sanctions order, the general licenses, and the trend towards, I guess, coming up with new trade arrangements similar to the Swiss humanitarian trade arrangement, I guess that would be the path forward. I do not foresee sort of a more broader-based lessening or toning down of the transaction sanctions, unfortunately. So that's my response.
So my next question is, how should sanctioned and other countries be protected from unintended economic damage caused by sanctions amidst the ongoing pandemic? And do you see opportunistic deals happening on a quid pro quo basis between the US or EU and other countries? In other words, would the US or EU lift sanctions for their own needs? And likewise, would they impose harsher trade barriers to prevent the export of material they need to tackle the pandemic? Surendra, could you take that?
Yeah, I mean, that is a very interesting question because, as you know, due to this pandemic, there's going to be almost a shift in how trading rules and how this global trading arrangements will evolve in time. With respect to, for example, just as a hypothetical, because of the prevailing situation, if a new country were to be sanctioned, for example, a country like China, I don't see that happening, at least a broad-based sanction. China is, I guess, one of the largest country with which has the supply of rare earth. So in that sense, I mean, this would be an interesting situation whereby, as you said, quid pro quo type of a deal, like, you know, whether or not you impose sanctions on the one hand, but then you need materials like rare earth and whatnot. What do you do in that case? With respect to US and EU, EU has tried to sort of counteract the far-reaching nature, secondary sanctions and far-reaching nature of the US sanctions by its own like various different ways, one of which is the blocking statute, which seeks to protect EU companies which have been trading with Iran, have business relationship with Iran from the secondary sanctions impact of US sanctions programs. But I guess there is always that sort of countervailing consideration for European companies as well. Do you continue to trade and risk basically being cut off from the U.S. financial system and hope that your own government will take the necessary measure to rectify or pay your damages for whatever actions U.S. will take against them? Blocking statute analysis is complex, and I don't think it's although the statute is in the book, I don't think it's widely used. And one of the other ways EU has tried to deal with this situation is by coming up with a special purpose vehicle, which is designed to, the SPV is designed to trade with another SPV in Iran, for example. And I guess the intent there is the SPVs deal with each other, and at least the intent is that it is so outside of your traditional financial system that in theory secondary sanction will not apply to these SPV-related deals. In the case of EU, the INSTEX, the Instrument in Support of Trade Exchanges, which is the European Special Purpose Vehicle, and the Iranian counterpart is the STFI, Special Trade and Finance Instrument. They have done, I believe, one deal so far, and it was for medical equipment. And so far, OFAC hasn't made a comment on that. And because it was a smaller deal and just for medical equipment, I think they have let it pass. But were this to be were this program to evolve and become larger, I don't think it's a excuse me. We don't know how OFAC will act, but it's anybody's guess that they would not like it. And there are provisions, OFAC provisions in the book, namely facilitation, and whether or not a special purpose vehicle created to sort of bypass OFAC sanctions will come under the purview of facilitation, and there will be enforcement measures against those companies as well. So to circle back, unfortunately, there isn't a whole lot the target nation, sanctions target nation can do to protect themselves from the effect of sanctions.
Thanks, Surendra. Nick, could you also provide your thoughts on this question?
So hopefully over time, the restrictions that we're seeing are going to be loosened because it would be unfortunate if the existing trade tensions were made even worse because of the pandemic. What I would rather see is an opportunity for countries to work together in order to meet the humanitarian needs of all of the world's people. That being said, currently, both the European Union and the United States do have certain trade restrictions in place that are intended to prioritize supplies of protective equipment and certain medical goods for domestic use. So they're going to look out for their own people first. But even while that's happening, we do see some movement toward using medical related items and protective equipment in order to contribute to relief efforts in other countries and to do so in ways that highlights the importance of, let's say, China as a producer of some of this equipment, or countries such as the European Union as being committed to humanitarian trade. And that certainly has a political dimension to it. We have also seen the use of Instex, which is the European trading platform for Iranian trade, in order to move humanitarian items to Iran from the European Union. And that is occurring alongside a Swiss humanitarian trade arrangement, which is designed to allow Swiss companies to engage in trade with Iran for humanitarian purposes. And there's been some reports in the media that Korea also will begin or is looking into setting up a similar type of arrangement. So we're seeing very publicly countries taking advantage of the opportunity to engage in humanitarian trade. And in some cases that is being done for political reasons, while other countries are certainly trying to prioritize their domestic needs first. And over time, depending on how long the pandemic goes on, either one of those trends might become amplified, where we might be seeing more humanitarian trade and a loosening of sanctions in order to support that and in order to allow those countries to be reasonably stable. Or we might see a continuing tightening of trade restrictions in a way that might destabilize some of these areas. And unfortunately, that seems to be maybe what is occurring with Iran and also Venezuela, based on statements that are coming from the United States, but also other governments that have made statements recently on those issues.
That's about all the time we have today. Thanks to all the participants for listening patiently. I would request you to email over any questions to contact@fintelekt.com and we will pass them on to the speakers. I hope this webinar has been useful and we look forward to bringing you the next Fintelekt ABA webinar on the 10th of June, where the topic will be ultimate beneficial ownership. Hala, Nick, Vincent, and Surendra, Thank you all so much for contributing to this session. Thanks also to my friends Ernest Lin, Amador Henrado, and Mig Moreno at the Asian Bankers Association, and my team members at Fintelekt for putting this webinar together.